The toughest financial decisions you'll ever make aren't about picking the next hot stock, they're the ones you make in your 20s. Because every dollar you earn, save, or waste today compounds into your future wealth or lack of it. A financial expert speaking to Yahoo Finance has issued a stark reminder for recent graduates and young professionals: forget the crypto hype, forget the day trading fantasies, master the basics first, or pay for it later. The advice comes as young adults face a uniquely challenging economic landscape: student loan burdens averaging over $30,000, entry-level wages that haven't kept pace with inflation, and a cost of living crisis that's turned simple milestones like moving out or buying a home into distant dreams. So, what are these non negotiable basics? First, build an emergency fund, 3 to 6 months of expenses in cash. Not invested, not in some high yield crypto scheme, actual cash you can access tomorrow. Second, maximize employer retirement matching. If your company matches your 401k contributions, not taking that is literally refusing free money. Third, pay down high interest debt aggressively. Credit card debt at 20% interest will destroy wealth faster than any investment can build it. And fourth, live below your means. The gap between what you earn and what you spend is the only source of future wealth. Markets are watching the spending patterns of this generation closely. Consumer discretionary stocks, think retailers, restaurants, streaming services, are highly sensitive to whether millennials and Gen Z have money left over after covering the basics. When young adults are squeezed, companies like Target, Starbucks, and Netflix feel it in their earnings. Conversely, financial services firms offering robo-advisors, budgeting apps, and low-fee index funds are booming as this demographic finally starts saving. Bond markets benefit when young savers pour money into stable, diversified funds rather than gambling on individual stocks. The winners here are clear. Discount retailers like Costco and Aldi thrive when young professionals prioritize value. Index fund providers like Vanguard and Fidelity win when the next generation chooses boring, steady growth over meme stocks. Insurance companies benefit when young adults finally buy renters or life insurance. The losers? Luxury brands that depend on aspirational spending, high-fee financial advisors who can't justify their costs, and payday lenders and credit card companies if this generation actually gets smart about debt. Globally, this matters because the financial health of young Americans drives consumer spending, which is 70% of US GDP, and the US economy still drives the world. Countries exporting goods to young American consumers like China and Vietnam watch these trends closely. In Europe, where youth unemployment remains stubbornly high in places like Spain and Italy, the same advice applies, but the opportunity to follow it is scarcer. Meanwhile, emerging markets in Asia see their own young professionals grappling with similar pressures, from housing bubbles in cities like Mumbai and Jakarta to student debt in South Korea. For jobs, financially stable young adults eventually become homebuyers, business founders, and confident spenders, all of which create employment. For real estate, if this generation remains locked out by student debt and low savings, the housing market faces a long-term demand problem. First-time homebuyers are the foundation of a healthy property market, and right now they're missing. What to watch? Student loan payment resumption and its impact on default rates, wage growth data for workers under 35, and whether the personal savings rate among young adults ticks up or continues falling. Also, track enrollment in employer-sponsored retirement plans, a key indicator of whether this advice is being heeded. Stay informed, stay ahead. This is World Financial News.